So there's a lot of different opinions out there when it comes to what is going to be best for each person. And I'm sure if you're paying attention to the different people out there, you'll see people complaining about certain types and advocating other ones. And so really what I like to do, I like to let the numbers tell me what design is going to be best. So what you get to decide is what is your goals, because different designs are going to help you meet different goals. Sort of. Typically, when it comes to insurance and really anything, the more you pay for something, the less efficient it's going to be, right? When you go out and you invest in a 401k or you investing in a mutual fund, there's some actively managed funds out there that charge a lot. You just kind of have to trust that they will do well. Data over the long term says that they're not going to really do any better than a passive index fund. And a passive index fund can be very, very inexpensive. So you got to decide, you want to take the risk and pay more upfront and potentially maybe get a better return, or do you cut go with the lowest expense and it has a history of performing, right? The lowest expense. So insurance kind of the same way. The more commission you pay the agents, the less is going to be in your cash value out of the gate. And that doesn't mean that company A that pays a higher commission than company B can't have a better performing product overall. Among company A's products, what's the best design? And among company B's products, what's the best design? You get to decide which company is going to be the best for you. And then how do we best design the products inside there? When I do the numbers in every carrier, the lower I make my commission, the better the performance is. It's very rare if I get paid a higher commission and you're going to end up with more money. Like anytime the agent gets more commission, you have less cash value right out of the gate. Some things are designed by the insurance company to provide more value down the road. And that may come with a higher cost at the beginning. Okay. But typically when we're going apples to apples, you lower the agent commission, your costs are going to be lower, not just at the beginning, but throughout the life of the policy. And you're giving yourself a better chance at a good performance, right? So I advocate for as much liquidity as possible early on. That comes from reducing agents' commission. It's not because I don't like money. I don't like high commissions. I would love to get big commissions all the time. Problem is it affects your policy in a negative manner when it comes to liquidity. I get people that are committing large dollars into their policies. And if you're going to commit large dollars into a policy and something happens that was unexpected, you stumble financially, the economy crashes, whatever the case may be, and now suddenly you can't make the payments and you may need to cancel the policy. Well, if we designed it with 30 years down the road in mind that you might maybe be able to catch up and earn a little bit more money, but you get no liquidity at the beginning, you're going to be out all of that money because we designed it in a way that didn't give you any liquidity out of the gate on the off chance that the dividend environment might change and you might end up getting a little better return 30 years down the road. That doesn't make any sense to me. That's how I try and weigh what's the best design. Now, some people, when it comes to the actual design in the policy, some people have a plan to just put a set amount of money into a policy and be done with it. Some people need flexibility that only certain carriers provide. And those carriers may have different types of designs in how many years you can pay into it, right? And so to work out really good for people who don't want to be paying in for large sums of money for long periods of time. I've got somebody that is committing $130,000 a year into a policy. Well, they know that they're going to do that for 7 to 10 years and be done. They're not planning to do that for 30 years. Maybe they could if they wanted to. And some people would argue that they definitely should. Well, that's kind of up to the client to decide, So if you want to pay in longer, we design a policy that can pay in longer. And that might mean a different carrier might be a better choice, but for the most part, that's the different designs and the different products, whatever product we end up going with, the way that I like to do things is we always try and optimize it for high liquidity early on, just in case something happens. We want the policy to not be a burden.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.